Hi, this is Roger Conrad. I'm editor of Canadian Edge. What I want to talk about today is what I think will be the emerging fault line between the better performing trusts and high yielding corporations versus the worst performing ones in the coming year. 2009 was a banner year. Our portfolios pretty much matched the gains in the S&P Toronto Stock Exchange Trust Composite, which is a broad-based index of trusts. And that's basically what we try to do in good years. We had a gain of about 65.5% last year. So a very good year by any measure. The year before that, of course, not such a great year. But a number of recommendations are still below where they were before the bear market that began in mid-2007 really got underway. But we're definitely on the right track, and the main reason is good businesses, and that's our mantra in Canadian Edge. We look for good businesses. We stuck with good businesses through the downturn. That's what put us in position for this remarkable recovery that we've seen since early March of this year. It's also put us in very good position for 2010, which I think will be a very good year again for particularly for the better businesses. Not so much for maybe some of the other the weaklings out there. The major fault line that we're going to see is basically the conversions from trusts to corporations, which will be taking place on an accelerating basis as we get to the end of 2010. As anyone who's followed this sector for a reasonable amount of time knows that basically investors have been anticipating a tax increase on the trusts beginning in 2011 since Halloween of 2006, and that's when the finance minister, Jim Flaherty, announced that the government would begin imposing a special tax on trusts and basically put the incentives in place for trusts to convert to corporations. We've had to date about 27 conversions to corporations, either announced or completed, and the surprising result is that in most cases the damage to dividends has been much less than expected. Roughly half the converting trusts have elected to not change their dividends at all. This is something, again, that not a lot of people expected. In fact, I don't know anyone who covers these things who really expected this to happen. In fact, most of the coverage that you heard was about liquidations, bankruptcies, and at the minimum, tremendous scalpings of the dividends. Some of the early conversions that we saw in 2008 actually did make some major cuts in the dividends. And the rationale of the managements was, well, as we convert to corporations, we'll have more money as operating cash flow that we can use to grow the business. What they found, though, was that their unit prices took some severe tumbles. And in fact made it very, very difficult for them to raise capital of any sort. Obviously, equity capital, issuing shares of stock, is very expensive when your share price is in the doldrums. But also, a low share price means it's much tougher to borrow money. And as we got into because simply lenders don't want to loan increasing amounts of money to companies if they're unable to back it up by issuing equity. So the early converters basically were caught in this trap. The later converters, though, have been operating under a totally different strategy, and that is by maintaining as much of their dividend as they can actually see their share prices rise and attain a lower cost of capital. Now, why is this so? Well, because the expectations have been so low for post-conversion dividends. And this is a theme we're going to see more and more played out over time. In other words, investors assume the worst in 2006. They've kept these things down because of the uncertainty about distributions, about what would happen in 2011. And as the actual results come in much more favorable way, and particularly for the trusts that don't cut dividends, and like I said, roughly half have not, we're seeing tremendous relief rallies, I guess you would call it. The uncertainty's blown away, and there's a relief rally, and we're seeing these things move to higher valuations. So this has only happened actually when we've seen the actual conversion announcements and the verification of what the post-conversion dividends will be. And so therefore, we have a large number of trusts out there that have not clarified and therefore are still trading at very big discounts to where they should be and where they will be as strong businesses once they make the decision to convert, once they tell us what that distribution is going to be. So again, this is a huge theme. It really goes back to the strong business model, and that is if you're buying strong businesses, chances are they're going to be able to maintain more of their dividend than is expected. You're going to get a nice pop in the share price, and that will make, I think, a great deal of the returns that we're going to get in 2010. There are other positives for the Canadian markets. The fact that their economy is coming on strong, much stronger than in the U.S. In fact, the bullish outlook for commodity prices, partly because demand from developing Asia is picking up, but also because demand in the U.S. is picking up. I think one of the most important news items on the economic front recently was the upturn in manufacturing in the U.S. in the fourth quarter. Very much unexpected, but very robust. That's going to mean more demand for energy. So that's bullish for Canada as well. But these trust conversions, I think, again, a very nice thing for those that do it right. There will be some that are going to be forced to make larger dividend cuts, and those will be the ones that underperform. I don't think there's a tremendous risk with the remaining trust regarding conversions, and that is because, again, because of the low expectations. It's also because the macroeconomic environment's improving. So those that have demonstrated strong businesses have been beating expectations, and even those that have made big cuts have actually beat expectations. And the result has been higher share prices, or at least stable share prices. Pretty much all the companies that have converted are now in better shape than they were, or in higher prices, which is also very extraordinary. But I think, again, what you want to shoot for in any market, or what's going to outperform, and what's going to outperform this time around in 2010 is going to be those that pull off their conversions in a positive way, again, beating expectations for distributions. So that's all I have to say today. We're going to be, of course, covering this theme in intimate detail. Going forward, we have a new issue of Canadian Edge going up this coming Friday, which is January the 8th. And we'll look forward to your comments from that. Hopefully it will contain a good bit of information, but we'll have more on this issue going forward. So thanks for tuning in. Look forward to speaking with you next time.